Welcome to Iron Financial. Look, we don't follow hype here. We stress test company foundations to see if they're actually built to last. Today, Sony's Q3 earnings report is on the anvil, and it's getting the full treatment. The headlines are screaming completely contradictory signals, leaving most of the market completely baffled. So is this corporate giant building a fortress on solid rock, or is this entire structure just resting on shifting sand? We're going to cut through all that noise, we're going to examine the actual blueprints, and we will determine if this is an opportunity to build wealth or a trap just waiting to collapse. Let's get to work. So here's our game plan, our blueprint for today's analysis. First up, we're going to tackle that central contradiction, the one that has the market completely spinning its wheels. Then, we dive deep to inspect the main engine room, PlayStation. After that, we'll test the strength of their other key support pillars. That's music and their incredible sensors division. And of course, you gotta look for the cracks, so we'll examine the weaker beams in their entertainment businesses. From there, we'll see what management themselves are forecasting for the future before we deliver our final, no-nonsense Iron Financial verdict. Okay, let's dive right in. The entire cloud of confusion around this earnings report really boils down to one central mystery. When you look at the top-line numbers, they don't seem to make sense when you put them side by side, and that's causing this huge disconnect between what the bulls and the bears are seeing. Right, hold on, analysts, let me jump in here, because this is the question everybody is asking me. I'm looking at this and my head is spinning. Operating income is up a massive 22% year over year. I mean, that's a huge beat, a fantastic number. But at the exact same time, sales of their flagship product, the PlayStation 5, fell nearly 16%. And not just any time, but during the critical holiday quarter. So how can you sell fewer of your main product but make substantially more money? It honestly smells like a shell game to me. So come on, what is the real story here? And that is exactly the crucial question. The numbers are precisely as you laid them out. On the left side here, you see it. PS5 hardware units down 15.7%. But on the right, consolidated operating income is up a really powerful 22%. Now, this slide frames the whole puzzle perfectly. The bears, they are laser-focused on that left column. They're screaming from the rooftops that the hardware cycle is peaking and it's all downhill from here. But the bulls, they're looking at the right column and seeing a company that's getting way more efficient and way more profitable. The answer to this paradox? Well, it isn't on the surface. To find it, we have to drill down deep, and I mean deep, into the segment data. And that all starts with the biggest segment of them all. All right, let's get into the guts of it. To really understand the strength of the entire Sony structure, we have to start at its foundation, and that is the Game and Network Services segment, or GNS as they call it. This is the home of PlayStation, and believe me, this is where the real battle for investor sentiment is being waged right now. And this is the number that has absolutely spooked the market. 8.0 million PS5 units shipped. Now that's a significant drop from the 9.5 million they managed to move in the same holiday quarter last year. This is what the bears are pointing to as the first visible crack in the armor. It's a clear sign that initial hardware boom, the post-launch rush, is slowing down. You simply cannot deny that a 15.7% drop in your flagship product, especially during the biggest sales season of the year, is a genuine cause for concern. A crack in the armor? Analyst? That looks more like a structural flaw to me. Hardware is what drives the whole ecosystem, right? If people aren't buying the box, the entire model just falls apart. But wait, now you're showing me that software sales are rising? How in the world are they selling fewer consoles but more games? That doesn't add up. Explain that to me. Exactly. You're hitting on the absolute core of their strategic shift. You see, while fewer new consoles were sold, the enormous, and I mean enormous, existing user base, all those people who already own a PS5, they went out and bought more software. 97.2 million games sold in a single quarter. That's actually up from last year. This is the very first clue that Sony is making a huge transition, from a company that just sells you a box to one that services a massive, highly engaged platform. But this next slide, this is the one that really drives the point home. And this just brilliantly illustrates the point. 132 million. Let that number sink in for a second. That's the number of monthly active users on the PlayStation Network at the end of December. That is an all-time record high for the company. So while all the bears are fixated on the number of new consoles shipped in a little 90-day window, the real asset, the true engine of future profit, is this massive, engaged, and still growing digital community. These aren't just console owners anymore. They are, for all intents and purposes, recurring revenue streams. So the solution to our big mystery from the start, it's laid bare right here on this slide. This table solves it all. Just look at the lines. Hardware revenue, you see it there on the top row. It's down over 15%, which just confirms the drop in unit sales. We knew that. But now look at the next two rows. This is where the magic is. Digital software and add-on content revenue is up 6%. Even more importantly, network services, that's the super high margin PlayStation Plus subscriptions, is up a massive 12.6%. What Sony is doing is consciously trading lower margin, highly cyclical hardware revenue for a fortress of high margin recurring digital and services revenue. They're not just selling consoles anymore, you see. They're building a digital empire. This isn't weakness. It's a brilliant strategic pivot to a much more profitable and resilient business model. But look, PlayStation isn't doing all the heavy lifting alone. A real fortress needs more than one strong wall to hold it up. So now let's examine the other core pillars that are supporting Sony's financial structure. I like to think of these as the steel I-beams of the company, providing immense and consistent strength quarter after quarter. First up, we have the music segment. And let me tell you, this thing is an absolute powerhouse. Sales hit 542 billion yen, and it delivered over 106 billion yen in operating income this quarter alone. This is not some small side business. This is a core profit center for Sony that consistently, reliably delivers, and it's all driven by the unstoppable growth of music streaming and a surprisingly resurgent live events business. Okay, I see the numbers, they're big, I get it. But is this growth sustainable? Live events can be really volatile, and let's be honest, how much more can streaming really grow? Are we looking at a temporary boost here, or is this a genuine long-term trend? That is a very fair question. But if you look at the drivers, you'll see this isn't a one-trick pony. Yes, live events and merchandising are booming right now, but the underlying engine here is streaming, and it is still growing steadily. Recorded music streaming was up 5% on a dollar basis, which is great, but the real gem, music publishing, was up a massive 13%. And on top of all that, they're making really smart strategic IP acquisitions, like Peanuts Holdings. This diversifies their revenue and builds a solid foundation for future earnings. This segment has multiple powerful growth levers it can pull. Now, we turn to the silent giant within Sony, Imaging and Sensing Solutions, or INS. Believe it or not, this segment actually brought in more sales and more profit than music this quarter. We're talking over 600 billion yen in sales and a staggering 132 billion yen in operating income. This is the unshakable pillar of the company, and it's built on their absolute total dominance in the high-end image sensor market. So let me be perfectly clear here. This segment's incredible strength is directly bolted to the high-end smartphone market. The source data points to strong shipments for a major customer, and let's be real, we all know that means Apple's iPhone. As long as premium smartphones demand better and bigger camera sensors, Sony profits. It's that simple. They're benefiting not just from a market recovery, but more importantly, from a technological trend toward larger, more complex sensors. And those bigger sensors, they are way harder to make and they command much higher prices, which makes this a powerful, high-margin business and a critical support for the entire company. Okay, analyst, you've shown us the steel beams, you've shown us the solid foundation, but every structure has its weak points. I want to see the parts that are under stress, the potential points of failure. Where are the cracks in the other segments? Let's talk about the weak spots. You are right to ask. No analysis is complete without a thorough and honest inspection of the weaknesses. And here they are, laid out plain as day in the numbers. Let's take our time with this. First, you've got the picture segment. You can see sales fell 11% and operating income dropped 9%. Now, this was a direct result of a really tough comparison against last year's blockbuster film slate. It's just hard to follow up a home run with another home run every single year. But the real concern for me is the second line, the entertainment, technology, and services segment. That's your TVs and cameras. Sales fell 7%, which isn't great, but operating income absolutely plummeted by a worrying 23%. This was driven primarily by a sharp decline in TV display sales, which, as we know, is a brutally competitive and low-margin market to be in. These are the areas that are dragging on performance, and they need to be monitored very, very closely. So we've seen the strong pillars, and we've identified the weaker beams. Now let's look at how management itself sees the future planning out. You know, the past quarter is just a snapshot in time. The real test of a management team's confidence is in the forecasts they provide to the market. So are they battening down the hatches for a storm, or are they confidently building for the future? And this is a powerful statement. Management didn't just meet expectations. They blew past them and raised their full-year forecast across the board. Just look at this table. They've boosted their sales forecast by 300 billion yen. Even more importantly, they've raised their operating income forecast by 110 billion yen, That's an 8% increase from what they were telling us just 3 months ago. This shows immense confidence that the strength they're seeing in gaming services, music, and sensors will more than compensate for the weaknesses we just talked about elsewhere. 1.54 trillion yen, a record forecast? That seems incredibly aggressive, especially when the company explicitly mentioned taking a pretty big hit from US tariffs. How can they be so confident? I have to ask, is this achievable, or is it just hype to prop up the stock price?
That's what makes this number so incredibly impressive. You are absolutely right to point that out. The company has stated they are absorbing an estimated 50 billion yen negative impact just from tariffs. So they're facing this massive headwind, and despite that, they're still raising their full-year guidance to the highest level in the company's entire history. That's not hype. That is a monumental display of operational strength and deep financial confidence. But they didn't just stop there.
Actions always speak louder than forecasts, and this action is screaming confidence from the rooftops. On the very same day as this earnings release, Sony announced a major expansion of their share buyback program. They increased the maximum purchase amount by 50%, from 100 billion yen all the way up to 150 billion yen. Now, for anyone watching, a buyback is when a company uses its own cash to buy its own shares off the open market, reducing the share count and boosting value for everyone else. A company that is worried about its future hoards cash. A company that is confident in its financial strength and believes its own stock is undervalued does this. It returns that capital to shareholders. This is a massive vote of confidence, a clear signal from the people who know the business best that they believe their own stock is a bargain. All right, we've inspected the foundation, we've tested the support beams, and we've examined the blueprints for the future. We've seen the incredible strengths, and we've acknowledged the very real weaknesses. So now it's time to put it all together and issue the final iron financial verdict. Is Sony an opportunity for your portfolio, or is it a classic value trap? The bull case here is crystal clear. The strategic shift in gaming to a high-margin services model is, frankly, a masterstroke. It's creating a recurring revenue fortress. And that fortress is supported by two other dominant high-margin businesses in imaging and music. You add in a record high profit forecast and a huge share buyback, and the foundation looks rock solid. But you can't just ignore the cracks, analyst. That foundation is built on a PS5 hardware cycle that is very clearly peaking. Hardware sales are falling, period. The pictures and the ET&S segments are weak, and they're dragging on margins. And you have significant external risks, macro headwinds like tariffs, not to mention a dangerous reliance on a few key partners, like Apple for phones and TSMC for chips. That doesn't sound like a fortress to me. It sounds like a building with some significant exposure to outside forces it can't control. That skepticism is absolutely warranted, and the risks are real. We don't ignore them. But our analysis shows that the fears are overblown. The crucial point, the takeaway here is this. The strength of the high-margin, recurring revenue businesses is now powerful enough to overwhelm the cyclicality of the hardware business and the weakness in those smaller segments. Sony has successfully transformed its core financial structure. They are no longer just a hardware company that's subject to these brutal up-and-down cycles. They are an entertainment and technology platform with multiple, powerful, and highly profitable engines running at the same time. The foundation isn't just solid, it has been re-engineered for a whole new era of profitability. The market's obsession with declining hardware units is missing the much bigger picture. Our verdict is clear. Sony's structure is sound and it is built for growth. This is an opportunity,